So one of the things that recently has been in the news has been tapping into your 401k in order to buy a property, whether it's to use as a down payment or any aspect of it, and it having some advantages in the tax department. Do you think that's a good idea to be able to do that early on?
To be honest, I think it's a great idea. It's not often where you look at stuff and you try to find the downside. And I can't really see the downside in it. Is giving somebody basically you're tax deferring the money so you don't have to withdraw it, because normally people have to do a withdrawal and they get hit with the tax penalty if they're using their 401k money for a house. And in this case, they're getting to use the money without the tax cost, and the 401k is gaining value as the house appreciates. If they end up doing it, I think this will be one of the best things that they could do,
It's
because
a
I
win-win
can't see
situation.
a downside, and I see a downside with everything.
Oh, well, that's charming. And we'll talk about this and more, especially the part where he's just not happy with life on the Loan Doctor podcast. We'll hear some more complaints coming up this hour. It's Richard Brandt and the Brandt Lending Team. Again, welcome to his waiting room. So let's talk about other things too that you can complain about. Because we hear about the stock market, Bitcoin, retirement accounts.
Yeah.
2/3 of people's wealth, however, is actually put into their homes,
Yeah,
at least here in the United States.
correct.
Why is it that we never talk about that?
Well, I think that the difference between like the real estate and the stock market and stuff like that is real estate. It's kind of like life insurance. It's stable and secure and relatively safe if you look at it historically. It doesn't have the exciting swings, and the swings are exciting when they're going up in the stock market. When the time like now is great, super exciting, and then right when COVID hit us and they were crashing and everybody was panicking, you go from excitement to panic, and hopefully you have more excitement. Think about the tortoise and the hare, that fable.
Hmm.
The hare is fast, boom, 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 sleek and everything.
Gets
It's
to where he
going
needs
good
to
and it's exciting.
be.
He's
Just
fun to watch.
Mhm.
But at the end, the turtle wins the race because he's
Yeah.
slow and steady. People aren't excited about slow and steady, so people don't think about it. But when you look at the wealth in this country, it's built on real estate.
That is a very good point. You're right. Bitcoin, stock market, retirement accounts, we're checking and we're hoping it doubles overnight.
Yeah, look, people hit a home run, and you try to time the market, which is also bad. And I think that we touched on this on an earlier podcast, is when you're talking about wealth building, diversification, I think, is really, really important. Having some money in stocks, having some money in insurance, having some, but also having real estate. And for most people, or for a lot of people, real estate is a really good vehicle to have this. And the one of the cool things about real estate is, when you compare it to the stock market, is real estate is like an option but safer. So an option from a stock perspective allows you to buy a position on a stock, right, without owning the actual stock. And if the stock goes up, you can make a lot of money. And if the stock goes down, you can lose a lot of money, right? Buying a house because you can get a mortgage, which is what we do, right? Buying a house because you can get a mortgage, when you think about the actual cash your cash you are using relative to the asset you control a much bigger asset. I was telling somebody this the other day. They were buying $1 million condo, right? Now in a resort area, very, very nice and everything like that. And she was worried because the property didn't cash flow, right? It basically broke even on the rental. But she's putting $250,000 down, 250, which is a decent amount of money.
That's 25% of 1 million.
Correct, 25% of 1 million. And if the property goes up conservatively, considering the area that it's in, 5% a year, let's just say 4% a year, right? 4% on $1 million, that's $40,000. If she used $250,000 and made $40,000, that's a really good return,
Yeah.
right? We're talking 50, I mean, doing quick math, 15, 18%.
And she still owns it, and
And
she's
she
been
still
living in
owns
it.
it, yeah. And somebody else is paying the mortgage.
Or,
Somebody
yeah,
else is
she's
paying
renting
the
it out.
interest. She's not paying the interest.
Yep.
So nothing else. And the light just kind of came on from her. So yeah, I think real estate is a great way to build wealth. It's not exciting, and it shouldn't be, because exciting isn't safe, and safe is where you want to put your dollars.
And it says here, home values have risen 78 out of the last 83 years. Put that in perspective as far
Yeah.
as what your return would be or your risk would be.
Yeah,
So
if you
why
want.
does real estate never get the credit it deserves? It just, people, like you said, it's boring. Maybe people just don't see it as exciting.
Yeah, I don't know if it never gets the credit. I mean, I do think that there's a certain amount of people who understand the value and stuff like that. But yeah, it doesn't get talked about. The consistency, that growth year over year. I mean, at some point when you're, out of the last 83 years, there were only 5 years that there was a downturn, and fundamentally, 3 of those years were brought on by the banking industry, which we don't even talk about. But or at least we don't have to talk about now, because we've kind of corrected some of those errors, sins of the past. But real estate goes up in value, and the other thing that changes, because real estate is always going up in value, the cost of the difference, or let me say it like this: the cost to go from no ownership to home ownership increases every year, because the value of real estate keeps going up.
So, according again to figures, 44 times is what homeowners have over renters. 44 times the net worth.
Yeah, correct.
So, if that's, an
Yeah.
accurate number, why would anybody pay, let's just say, X amount of rent, let's say $5,000 between one thing and another? Why would they pay that as opposed to purchasing? Where is the psychology behind renting for 15, 20 years?
Well, I think what happens a lot of times with renters is they 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 don't prioritize distance, right? It's how do I solve an immediate need and only care about the next 6 months or 12 months, as opposed to looking at things the way that a business makes decisions, and say, well, okay, let me make a decision that is going to impact me 5 or 10 years down the road. So a lot of times people are renting, and they can afford $5,000 a month in rent, so they're paying $5,000 a month in rent, or worse, they're paying 52 or 5,300, whereas they could have paid 4,000 or 3,500 in rent, maybe not lived where they wanted to live, or had every single feature that they wanted, but now that $1,500 they could use for the next 5 years. Right? Say if you're saving $1,500 a month for 5 years, that's $18,000 times five. Now all of a sudden you've got, I don't know, I probably should have done the math in my head, but it's close to 100 grand.
It's
That's
about 90,000.
yeah. But I think it's 92.
You're
But
probably right in that
either
one.
way, no, 90. I think you know what? I think actually 90 is right. I shouldn't have corrected you. That's terrible. But that was awesome. But I think that I just think that people, when they're renting, it's a short-sighted thing, and of looking at your future. And I also think that there's, some people rent because in some cases renting can be a little bit cheaper than owning. Sometimes they rent and they take their money and they risk it on make other investments and stuff like that. I have a couple clients who buy investment properties but don't own a home. It's their thing, and I'm more. I don't know if it's because I'm older. I'm definitely more buy your house first. Make sure your foundation is solid, and then go do it. But there's different paths.
So when people say home equity,
Yeah.
what does that actually mean?
Oh. So home equity is the difference between what your house is worth and how much you owe on it.
So, for example, this example that you gave of the $1 million condo,
Hmm.
if she put 250 down,
Right.
does she have 250 in equity?
Right. She has a $750,000 mortgage, so she has $250,000 in equity. And if we expand that scenario to a year from now at 4%, now the condo is worth $1,040,000, and she owes a little bit less than 750 because she's been paying it down. So now she has more than 250,000 in equity. No, she has close to 300 in a year.
Now, I've noticed too, a lot of people purchase their home and then they just don't do anything with it. They just live it out. How much should you invest in fixing up your home? How much should you invest in seeing the value of keeping it up like you would your car that you take to maintenance every 3 months or what have you?
I think as the answer is for most things, um, the answer really is it depends. I think that most of the time, most answers are it depends. It's hard to give, and it's funny because you look at books and experts and all that, and they're always giving advice on how to do something, as if one solution is right for every single situation, and that's not the case. Should you invest in doing improvements on your house? Probably. A lot of time, depending on what you should do is make sensible improvements. What you shouldn't do is put a $50,000 toilet in a $400,000 house.
I wasn't thinking the toilet, but yeah, we could do that too. That would make sense. So you've said before that a mortgage is what they call kind of quote unquote forced savings.
Yeah, love it.
What does that mean?
Love it. So what happens with most mortgages is that every month you make an interest payment and a principal payment. So the principal is your money. That principal is basically going to your home's equity, your equity. And so fundamentally, a mortgage is really a vehicle, a forced savings account, where the assets a little bit harder to get to than if you were to put the money in the bank, right?
Yeah, there's no ATM to,
There's no ATM to
yeah.
get the money out. There's processes to get money out at some point when you need it, but the idea is every month you're paying a portion of your money is going to your equity, which is your net worth. And the longer you have the mortgage, the more of the amount that you're paying is going toward that forced savings.
And how does leverage work when we're talking about real estate? So why, for example, how does leverage make real estate so powerful compared to other investments?
So if we use that example that we were talking about earlier about the option, a stock option uses leverage. It's using leverage, but it's putting you in a very risky situation. And using leverage from a house perspective again allows you to use a little bit of money to control a much larger asset. And if you think about just business in general, just the science behind leverage, the richest people in the world are the richest people in the world because they all use leverage.
They all
Right.
took risks too.
They did, but what happens is they use the resource. There's only so many hours in a day, so much that I can do,
Hmm.
right? If I want to make more money, what I got to do is I got to find somebody who's going to do work, right, for a certain fee that I can make more than what they're charging me, right? And the more people I employ to do that, the more money I'm going to make, or the more money that they make me compared to what they're paid, the more money, right? So FedEx, makes a ton of money. They pay their drivers a fair wage and all that. But when you add up the total amount that they deliver, FedEx, the company, the CEO, he makes a lot of money because of the work that somebody else is doing. So functionally, leverage is simply in the banking world, other people's money. You're using somebody else's money to add wealth. I talk about it from a real estate for real estate investors. This is one of the great things about real estate investment. If you're buying an investment, right, and the return on your investment is 8%, and you're paying 6% for the money, I'd borrow $100 million if somebody would give it to me, because
Wow.
then I'm making 2% on somebody else's money.
Right. Right. So what happens financially when somebody is able to buy a house today and waits, let's say, 5 years to buy?
Waiting is. Uh, I don't know if we're going to get into it in terms of like timing the market and stuff like that. And
I'm saying if they have the money and
right.
they can today.
I think that what happens is some people wait because they don't. They're afraid. What if prices go down? What if rates go down? What if?
What if
What if
my
I need the
job
money? My job.
changes my location?
Yeah.
Right.
Well, the job thing I kind of get, but I understand that people have lots of fear and stuff like that. And the thing that I can tell you that I've seen firsthand is that I have seen people say to themselves that they're going to buy a house in the next 5 years and wait to make the decision or wait to do it, only to find out in the 5 years now they can't afford to.
Because
And
the house price
the
went
house
up.
prices have gone up, interest rates change or whatever. For whatever reason, they went from a situation of where they could have bought then, didn't make it a priority, and now it's beyond their reach. And that's probably one of the saddest things. I don't think you might beat yourself up if rates go down a little bit, or if you pay a little bit more for the house than your neighbor.
Mhm.
Maybe you beat yourself up a little bit,
Yeah.
but that's nowhere near how much you beat yourself up when you lost the opportunity when you never had the opportunity because you didn't take advantage of it.
When you turn around, you realize that the house that you are now willing to pay 500 for was 100 the first time around
Oh,
when you could have bought it.
I got a guy that I was talking to 4 years ago, had a chance to buy a property, didn't buy it, and to this day he calls me up to tell me how he can't believe he missed that opportunity.
So when we talk about inflation, because you were talking about rates going up or home prices going up. So let's talk about inflation itself.
Okay.
Is there any way that inflation helps home buyers or homeowners?
Again, the short answer is it depends. It depends. Inflation can be good. And inflation isn't. I mean, inflation is going to make the cost of money more, right? The thing that I often say, it's so funny just because I really focus on we are where we're at, right? I know a lot of people say that oh, when I'm going to wait till rates come back to 3%. And historically, rates were never 3%. 3% was an anomaly, right? And if you're waiting for rates to return to 3%, that's probably not going to happen in your lifetime unless we have some type of economic catastrophe like we
Well, like
had.
the pandemic,
Well,
and everybody said, "Oh, it's like 1918." Were you alive in 1918?
yeah,
Because I wasn't.
no, you, you
Right.
you had the pandemic, you had the
Right.
housing crisis, God, hopefully those things don't happen because a stable market is about where we are now. We might be on the high, like leaning on the high side of a stable market, that's anywhere from 5 to 7%. But that's kind of where you want to be. So people who have this 3% thing are just they're not. It's not realistic. It's not sustainable and stuff like that. But the reason I sort of talk about it is think about it like this: when rates were 3%, what were you getting in your checking account?
Zero.
Right. Okay. Now that rates are 6, right? What is a CD paying?
Easily 2.53%.
3, right? The spread is still 3.
Yeah.
Yeah. It doesn't matter. It doesn't matter what the cost of money is. If the cost of money is higher, then you're also making an equal amount more on the money that you have. So the net spread is really almost the same. So I try to focus on what it is now when I'm talking to a home buyer about buying and they're thinking about waiting. My answer most of the time, if they're able to afford it and all that other stuff, is if you find a property you like at a payment you feel like you can afford now, do it. Just do it because you don't want to you don't want to not have the opportunity later. And we've talked about this before, but you might buy the house, you just date the rate. If rates get better, you can always lower the rate. You can always extend the term or do all kinds of things to make owning that house more affordable or affordable. But you
Well, you just
can't miss out on that opportunity.
hit a nerve with that. You could always refinance. When do you know is the right time to refinance? Let's say somebody got an 8 or a 9% during the last 2 years. How do they know how
Well,
low the
again,
rate should get before they
it,
refinance?
again, it depends on their situation, why they're paying 8 or 9%. There might be a reason, but What happens is the time to refinance really is based on a few things. One is your time horizon. Okay, when you refinance, there are closing costs, right? You're going to get a lower payment, but there's closing costs. So if you're saving $100 a month and you have $10,000 in closing costs, right? It's going to take you nearly 8 years to break even. That's a long time horizon to see the value of the refinance.
Are you going to be in the house that long?
Right, right, right. But if your closing costs were 5,000, now you're breaking even in 4 years and 2 months, right? 4 years and 2 months. Is that time horizon something that's comfortable for you? Generally, as a rule, if you could save enough for the cost and you're going to be in the house, your plan on is being on the house a long time. If your time horizon is that you can say you'll get back your money in 3.5 years, then it makes sense to do. One thing that people will get hung up with, and I'm sort of glad we're talking about it, is escrows. When you're refinancing a property, if your current lender is collecting for your taxes and insurance, right? They've got money set aside. It's your money. It's always your money, right? Escrows is always your money. So they've got this money set aside for taxes and insurance. And then you're getting a new loan, right? The new loan has to collect for taxes and insurance based on whenever those two things are due, right? So they might be collecting a lot of money and you're going, well, wait a second, why are my costs so high? Well, really what we're doing is we're collecting for your escrow for taxes and insurance, but your old lender, they've got money for you that's going to be part of that money that we're collecting. So escrows isn't really a cost, right? So if we go back to that analogy of how am I breaking even in 3 years, you can't count escrows because you got to pay taxes and insurance no matter whether or not you refinance.
Well, you could also choose not to take escrows out, like, and pay them yourself. But it's very hard.
Yeah.
At the end of the year, you get that tax bill that you had the discipline, not everybody does, to have that total payment.
Yeah, I think different situations call for escrowing or not escrowing, but absolutely. But I think what
Yeah.
happens a lot of times people like some of my clients until they realize is they get hung up on why is it costing so much, and really if your insurance costs $5,000 a year, and we'll just kind of do this. I generally don't like to talk numbers because it gets confusing, but we'll use some round numbers. If your insurance costs $5,000 a year, and your insurance is due in the month of May, and we're in the month of March, right? The bank needs to collect 12 months of your insurance because if you're closing in March, your first payment isn't until May. So they have to collect 12 months of your insurance. So now that looks like all of a sudden, well, I've got to pay $5,000 more in cost. Well, no, because your other lender, right? They've already collected $4,200 of your insurance. So really, you're just paying for that month that you're not making a payment.
Now, as far as the emotional side, because
Did I lose you
numbers,
with the math?
no, not at all.
Oh, good. All right.
Not at all. It made perfect sense to me.
Okay.
But on the emotional side, because I know it's not just financial when you're looking at purchasing a property, tell me about one of the stories of you helping a family where the family itself could come back and say, "Hey, I know that this wouldn't have happened maybe without your help." And I'm not talking
Wow.
about numbers. I'm talking about the emotional side of turning renters into home buyers or
Yeah. So
homeowners.
so so I will tell you one of the more moving experiences I've had, and I could say another one if you've heard this because I'm not sure if we talked about it before. I have a client that's a really good client who's become a friend, like so many of my clients have, and he ended up referring me his nephew. His nephew had recently become self-employed, or maybe like for a year and stuff. He actually had gotten out of jail and was turning his life around, and he he came to us. He wanted to buy. He really wanted to buy. He wasn't mortgage ready. it took us a little bit of time to get him mortgage ready. We helped get his credit up. We helped to make sure that we checked in on him every month to make sure the finances were going the way that they were going to do. During the process, while we were doing this, his father passed away.
Ugh.
Um, and so his father didn't get to like see him the results, but either way, he stayed steady and strong through all this adversity.
Mhm.
And then he was able to buy the house. He knew the house that he wanted to buy. He was able to buy the house and stuff like that. I think we closed maybe 4 months after his dad died, and
And he wishes dad would have been able to see that.
probably. But I mean, it's touched me so much. I actually went to the funeral.
I believe he did.
But that's kind of what happens. That's one of the more touching stories I've had. I actually had somebody visit me in my office yesterday. She closed on a house, and just so happened that the house she closed on was maybe, I don't know, 2 minutes, 5 minutes from my office, right? So she was like in the area, boom, boom. She just figured she'd stop by to see if I was in to thank me for how much I impacted her and in helping her get this house.
That's
And
very
so
cool.
we have tons of stories like that.
So there's something called generational wealth,
Yeah.
but you kind of mentioned the nephew and family members that we can help. How can we help our children and our grandchildren have a more solid financial foundation?
Real estate is a good way to build wealth, and real estate is something that can be handed down
Hmm.
to the next generation. Especially an investment property that's got good cash flow and stuff like that. There's no reason that the family can't keep it. I was talking to on another podcast. I was talking to our lifestyle protector, Dwayne Merchant, and we actually we're going to put some numbers together because we were actually talking about a way to leverage the equity in your property so that you could use some of the money, but also attach an insurance component to it so that you would actually have something to leave behind if something were to happen.
And for the kids that are growing up in a homeowner household, not a renter's, but a homeowner household, what can we teach the children about keeping the stability for their future? Like, how do you speak to a child and let him know the value of there's a stability in you living here many years and going to the same school and having the same friends and seeing the value of this is how much we paid for the house and this is how much it's worth now? You definitely want to look into this area. Like, you want to gear them towards ownership.
It's funny because if you look at like the educational system,
Yeah.
I think part of the curriculum should teach kids how to balance a checkbook. Should
Do
teach kids,
taxes.
yeah, how to properly budget,
Of course.
and to teach kids the importance of savings because, you know, savings when you're young is tremendous because it grows that exponential growth that you have for the years and years and years. And I think if you teach kids the importance of saving when they're younger, they're going to understand the benefits of owning a house as they get older.
Yeah, I heard a teacher say that part of the reason that they have kids selling, chocolates or little magazines or whatever in school is just to get them prepared for business ownership. So it's interesting, those little kids that had lemonade stands, they figured out how to make a return on investment. And that happens too if you can teach them from early on how important it is to have a home that you own.
I was the king of sales when I was in elementary school. I won a
Really?
sales contest. Yeah, yeah,
What
yeah.
did you
We,
sell?
we were selling spices.
You were selling spices?
Spices, yeah. It was like a
So
pack.
cayenne pepper and
It
all
was,
those
yeah. It
things,
was like a
it's
pack
salt.
of like 5 different spices
Yeah,
as a thing and all that kind of stuff. But I was relentless. I was the king, and I sold more than anybody in my elementary school.
I could see it.
Yeah, I can't remember what I won. I like an Atari or something.
So for people who are thinking that rates are high, because you mentioned that
Yeah,
home prices are high.
yeah.
So does home buying work for them better than renting when they're so insecure?
So here's the thing, like rent's 100% interest. There is some risk with buying a house. You have some additional costs because you got to take care of the property and stuff like that. But if you balance what you're doing in an affordable way, there is no reason to wait to buy a house. Again, I think timing the market, whether it be stocks, whether it be real estate, is crazy, right? Look, if you're an investor looking to do a fix and flip, or fix and then sell the property really fast, then what you pay for the property is super important and all that kind of stuff, and I get it. But for most people, your time horizon for a property should not be, is my property going to be worth more tomorrow? It's, is my property going to be worth more in 5 years? And in that scenario that we talked about where home prices have gone up 78 out of the last 83 years. So there's a good chance that over the next 5 years, every year, maybe 6 months of 1 year, every year the prices are going to go up and you're going to have a lot more equity. And you don't know what rates are going to do. You don't know what life is going to hold for you. And renting is, you're throwing away money.
Now, that you said that with the market, are people too focused on short-term market noise?
Yes.
The short answer.
The short answer
And what's
is
your
yes.
next question? Yes.
It goes back to that question. Is the situation is what it is, right? And we talked earlier in the show about interest rates and how when interest rates were 3, when you were on your money, you were getting less. Now on your money, you're getting a little bit more in a safe way, right? And so I think the market is the market. If you can afford a house, or you can adjust, because one of the other things that people often do when they're buying their house, especially first time home buyers, they want to go from no ownership to their dream house, right? And there are very little things in life that you go from the start to the finish line.
Well, think about it. Was your first car the Ferrari?
Right,
Right.
exactly right. You have to kind of,
Right.
especially with the house, you kind of have to build up. So what I tell people is if we're buying our first home, let's buy a house that we can live in for 2 to 3 years. That's it, 2 to 3 years. If you end up staying longer, great, but look for a house that you can live in for 2 to 3 years. Because in 2 to 3 years, now we can start thinking about getting something bigger. It doesn't necessarily mean that you will, right? But because if you can stay there for 2 or 3 years, you could probably stay there for 4 or 5 anyway.
Mm-hmm.
But the idea is you don't have to buy the dream home on day one. You can build toward the dream home. So going back to your question about like waiting and stuff like that, if it's affordable for you, rent is throwing away money. Buy a house that you can comfortably afford, and let your money work for you instead of throwing your money in the garbage.
Or actually, you're paying off somebody else's property.
It's you said to me earlier today about like you hate wasting food.
I did say that.
Right.
It just, you have no idea how it hurts my heart to throw away food.
Throw away food.
It hurts my heart because I just know how valuable it is to people that don't have it in front of them.
Yeah. So when renting is like throwing away food.
So as a loan officer that is continually taking advanced courses and workshops, because you never stop learning, right? And especially as things
No, I'm done.
change.
I
And
know everything there is to know.
you know everything.
I'm
You wrote
done.
all the books.
I'm done.
If
Yeah,
I go
yeah.
to,
Yeah,
to
I
the
finished
bookstore.
learning. Life is really boring because I'm all done.
So as somebody who's continually learning, what has the last 80 plus years of housing cycles, like you touched on the crash in 2008. So those housing cycles in the last 80 years, what have we learned that gets us to why we need to purchase a home in the next few years and if possible the next few months?
Because house prices continue to rise. Prices continue to go up. Again, saying what I said before about the cost of no ownership to home ownership, the ownership gap keeps growing, right? So waiting, like in 5 years from now, it's going to cost even more to buy your first house, right? and hopefully that 401k thing that we talked about earlier will kind of help some people with that.
Now that you said that,
Yeah.
it just, again, it struck another nerve because timing the market, I feel, is riskier than just being in the market.
Yeah, of course, it always is. It
And
always
and that
is.
goes to that 401k that maybe if all the right signatures are on that piece of paper, maybe we'll be able to use that 401k for our down payment, because that's kind of one of the big challenges in for first time buyers is they don't have all the money it takes to come to the closing table, but they will, and they still own that house. So when you say, well, if I'm using my retirement money, you're using it to purchase something that's going to grow in value. That is your retirement plan,
Look,
and you've been living in it the entire time.
I think, the fact is stocks go up and down in value, right? I mean, when you have a 401k, there's a chance that you lose money. There's a chance that you make money, and all that. And more often than not, the odds are that you're going to make money. Um, Buying a house is no different. There's a chance that you could lose money. The greater historically over the last 80 plus years, it stands to reason that you're going to make money. And then fundamentally, that's really what a retirement plan is about, is making sure that we're forcing you to save money that's going to be worth more in the future than it is today.
Now, if someone feels that they're priced out now,
Yeah,
it's already too high.
yeah. Look for a
What's a
cheaper house.
okay?
Sorry, go
As
ahead.
simple
No,
as that.
no.
No,
Finish your question. Yeah.
my question was, what is a smart strategy instead of giving up? What is a smart strategy? Where do they start? And you said, buy a cheaper house, live in it maybe 2 or 3 years, and then use that
Yeah.
house to buy your next house, right?
Correct. Right. Change your philosophy from an accumulating wealth standpoint,
Mm-hmm.
right? Change your philosophy from I'm not worried about what's going to happen. I'm not worried about what's going to happen tomorrow, but I'm also not worried about what's going to happen in 10 years. Make your life cycle 2 to 3 years, and shoot for the goal there, and see how much different the results would be, and then you know the right answer.
Now, is there somebody who should not buy a house right now? Who should not buy?
Wow, speaking as a mortgage guy,
Yeah,
yeah.
who should not buy?
A 17-year-old, because they don't have credit. No. Well, actually, it's funny. I'll tell you somebody who it doesn't necessarily make a good buyer. Um, I had a guy, a client who makes money trading internationally, and I don't know how risky it is. I don't pretend to understand what he does because, boy, I have no idea what he does. But the returns he makes on the money is obscene, right? If I'm making 15% on my money, I wouldn't tie anything up in real estate because I can't make that kind of return. I mean, depending on your income situation and stuff like that, um, there's there's I would say that I would say this: the type of person who should buy is the type of person who has the ability to regularly save money, even if it's just a little. Like if you're able to save $100 a month,
Mm-hmm.
you're or even $50 a month. If you're able to save $50 a month, you're a candidate to be a buyer.
And that should be everybody.
It's a lot of people. You just have to, kind of prioritize what you want. And I mean, there are people who can't buy because of credit and things like that, and the way they make their income and stuff like that. But if you're asking me who should buy, it's anybody that can consistently save something is probably a good candidate for home ownership.
Yeah, my question was who couldn't, and I guess somebody who can't save 50 or $100 a month.
Yeah,
If
yeah,
you can't save it, don't do it.
yeah, yeah,
Don't do
yeah.
it because there will be a rainy day when that AC breaks or something else happens.
Well, I think that having an ability to regularly save just kind of lets you know that you're able to handle those swings that you just kind of talk about, like the AC.
Okay, so let's take it back to the basics. What is the difference between a fixed mortgage and an adjustable rate?
Mortgage?
Well,
Uh,
what's the difference?
yeah.
Because I've heard lenders say both. So, How do I know which one is to my advantage? Adjustable or fixed?
So as most things, as I often say, is it depends. Right now, there's not a big the mortgage rates. 30-year mortgage rates tend to follow the 10-year Treasury, and short-term, like ARM loans, adjustable rate mortgages, tend to follow the 2-year Treasury. And if you look at before COVID, the spread between the 2-year and the 10-year was big, and that made ARMs, adjustables, really advantageous. The spread is much tighter now, and we probably need to see another 1% movement in the yield spread, the difference between what the 2-year bond is trading at and the 10-year, for ARM rates to really become advantageous. But basically, a fixed rate mortgage is fixed for the duration of the loan. If you have a 30-year fixed, it means your interest is never going to change for the next 30 years. With an ARM, they can change. Typically, the most common ARMs are like a 3-year ARM where the payment could change every 6 months, or a 5-year, 7-year, and in some cases a 10-year. And then they have caps to protect you from going, one way or the other in any big swing. And they offer some advantages because getting an adjustable rate gives you a slightly better rate. The question you have to ask yourself is the slightly better rate worth the risk and the change that could potentially happen depending on my time horizon for how long I plan on owning the property? So so the situation is, it depends. If you're only going to own the property for 3 years and you're thinking that you're going to sell it, well, yeah, doing a 3-year ARM kind of makes sense, right? Why pay the extra interest if you can save a little bit of money, even if the money isn't, even if the savings isn't that big a deal?
So the ARM is good for investors who are constantly buying and flipping?
Again, I mean, it depends on your time horizon. Yeah, if you're buying and flipping, sometimes what ends up happening is you end up buying a house and you decide, oh my God, this is a great rental, I'm going to keep it. And then what do you do? You got to be really sure that you're going to dispose of the property to get an ARM when it's not super advantageous. I actually had a lady call me today because they're ready to refinance. They want to pull some equity out, and they had a 5-year mortgage, and the mortgage is ready to change. Because in 2020, when we got the mortgage, the spread was good. It made a lot of sense. They saved more in interest over the last 5 years than it would cost to refinance to where we're going to refinance now.
As far as down payments,
Mm-hmm.
what is a fair percentage? 5, 10, 20? What should be expected? How does this change in the closing costs?
Well, I mean, down payment is an important element of the thing, of the process. And I think that a lot of people have this conception that you have to put 20% down, and 20%, avoids MI, and MI and
MI is mortgage insurance?
and mortgage insurance is bad,
Uh-huh.
right? And I would say none of that's right in every situation. I think first-time home buyers can put as little as 3% down, and in the right situation, I think that's perfectly okay.
Does that make it more difficult for closing costs?
Well, it doesn't really impact closing cost. I mean, the loan size is higher. So when you have closing costs on a loan, you have costs that are unrelated to the loan amount, and then you have costs that are related to the loan amount. So with 3% down or 5% down, your closing costs might be a little bit higher, just because of depending on your credit score, right? So if you want to put a low down payment and your credit score is high, your closing costs probably aren't going to be that different. But if you want to put a low down payment and your credit score is low, yeah, you're probably going to have a little more cost.
I've heard you talk about points.
Mm-hmm.
So how do buying points work, and how many points can be bought? So if right now you said to somebody, okay, it's going to be an 8%, can they buy it all the way down to a 5?
Stop saying 8%. You're scaring the shit out of people.
Did you just curse on the
I
mic?
think, I
Oh my
think I might have.
goodness. Oh my goodness.
No.
No, I'm just saying, can they buy points down to 5?
Yeah. Okay. So that's a really great question, because what happens? So discount points, origination fees, whatever, however you want to call them, they all are basically the same thing. All points are prepaid interest. I'm paying interest today in exchange that I don't have to pay it tomorrow. And if we can use a scenario of, I'm just going to use a scenario of $100, okay? Because it's easy math. If I give you $100 at a 6% interest rate, you're going to pay, and you only paid interest only, you're going to pay me $6, right? If I give you an interest rate, if I tell you that I'm going to give you an interest rate of 5% instead of 6%, but you have to give me $1 to get or you have to give me $2, or actually, let's say $3 to get the 5%, right? So you gave me 3 points, and your rate didn't go down to 3%, it only went down to 5, right? You gave me 3, you give me back $5. Now, if you kept the loan for a year, that was a bad idea, because really, at the end of 1 year, you could have paid $6 in interest, and instead you paid 8, because you paid me the 5 plus the other 3.
Right. So it's,
Right.
again, being sure
So,
about what your decision is.
well, kind of, but now let's take it out to 5 years, right? So now 5 years, if I'm paying interest only, I'm paying $6 every year. At the end of 5 years, that's $30. If I take the $5, I'm paying $5 in interest over the 5 years. That's $25 plus the 3 I gave you. That's 28. I saved $2 by doing that, by giving you the money up front. So it all has to do with the time horizon of how long you're going to be back in the money, or how long you're going to be in the property, how long it's going to take you to make that money back. And the other thing that happens with interest, or prepaid interest, is that the mortgage rates don't trade in even increments, meaning that so mortgage rates typically trade like change by an eighth. So if we're using 6%, it's 6, then 6.125, 6 and a quarter, 6.375, or 5.875, 5.75. So interest rates don't change, or they change by an eighth of a percent. But the cost, every time you go down an eighth, it's not the same each time. The costs vary depending on where you are on the matrix. And so there are some times where there's good value, and sometimes there's bad value. The trick to paying points is, where's the spot that has good value? And that's kind of part of what we do. That's part of our expertise, is making sure you're getting the right value for what you're trying to accomplish.
Which is why you need the loan doctor to come through for you,
Yeah.
and actually figure out these numbers,
Yeah.
because the truth is, there is a little bit of the graph. This is where you want to be. This is where you want to be, and this is what you need to do on this side and this side, so you get there.
I had, this is going back like 4 or 5 years ago, because we're going to talk about, one part of your question is there a maximum you can pay? That can I buy the rate all the way down? And there is a floor, but there's something called a high-priced mortgage loan, meaning that a loan can't have more than certain costs. But I had a guy come to me who we ended up doing his loan. He was a financial planner, and he wanted to know the lowest rate that he could get. The lowest rate, he wanted a 15-year fixed rate mortgage, and he wanted the lowest rate that was available. And I'm like, what about the points? No, I don't care. I want the lowest rate, whatever the lowest rate is. So I gave him the rate. I think the rate was like 2.1% or something.
That's crazy.
2.125.
Wow.
Like a ridiculously low rate, right? But it came with a ton of points, like the cost to get it down there. And the other thing that made it weird of what he wanted was, he wanted to know the total he would pay back, his total cost after 180 months. Okay, so, which is the 15 years. So because my loan had the lowest rate, right, even though my costs were a little bit higher, but I had the lowest rate over the 15 years, my costs were lower than anybody else's total. And he's like, well, don't you have to add this? I'm like, well, no, because you're only paying back. You're rolling the cost into the mortgage because it was a refinance. You're rolling the cost into the mortgage. You're only paying back the interest. That's all you're paying. And he goes, okay, let's do that. Now, the problem with what he did is the time horizon for money. So because the cost got prohibitively worse as he brought that number lower and lower and lower, it means he has to live in the house for like 12 years before he actually saves the money he thinks he's saving. And that's just to break even.
Yeah, that's rough. Yeah, that's rough.
And he was a financial planner. Not my financial planner, but a financial planner nonetheless. And hopefully not yours.
You're still in business, and here I am. So I think we're okay.
So yeah, that was probably one of the strangest things. But there is a ceiling to how low you can buy. You can't have a high price mortgage loan to protect people from that.
So I had a bunch more questions, but I'm going to save them for the next time we have a podcast because I'm kind of out of time here. Yeah, I got lights flashing in my face that you can't see. So, so we're going to wrap it up. This is Richard Brandt. It is the Loan Doctor Podcast. Thank you so much for being here with us, and thank you for being in his waiting room.